Silver's been a dog a number of years here relative to gold. You find yourself back up in the low 70s in silver again. Once we turn up out of the third break, either we go to the 50s, and I'm wrong, or we hold here again and just below 70, you flip back up. You flip back up into the low to mid 70s again on silver. You look at a price chart, that doesn't mean much. But to our metrics, it says, hey, you're coming out of here, and you'll probably come out of here in a jolt. And silver's had a supply-demand deficit for half a decade. We're half the dimension of the gold prior to bull markets that had far less explosive fundamental reason to go up than we do now. So even JP Morgan a few months ago put out a report that ultimately $9,200 gold would not surprise me. Well, if gold goes to 8,000, you imagine where silver is, since silver is now outperforming gold. 120 silver and 5,600 gold. There are numbers not far overhead that will do that. I do think silver has signaled via various metrics, last year mainly, it's going into a tantrum move, like copper did and lead did, and gold does every time, eightfold moves. Silver, for some reason, capped forever.
So what do you see in terms of the price action for gold? If we're kind of in this tipping point that you're concerned about, where do you see gold and silver going?
Okay. I since the February collapse, gold and silver, again, go back to February 3rd on silver and that date on gold, and draw a line sideways. It's been 6 months of repeated waves up, down, including the cleansing downside wave in late March, which swept that early Feb low. So we had that, we run the stops, so to speak. So now we're still in that range, okay? Yet it's been 6 months and the constant selling, repeated selling. Every time you get under 70 by much, what happens? Somebody buys it, you know? And I think there's a fight going on here that really is more balanced than people give it credit. Most people just see the downticks and get emotional. They don't, you know, there's upticks that come in between. You go to 70, 80 again. Well, this horizontal pattern won't persist. Either the bears are going to win this and take us down to 50 something, like the majority think. And it better happen like yesterday. Okay, it better happen Monday and Tuesday, because our short-term technical metrics, momentum-based, and our weekly momentum metrics, and our monthly momentum metrics all argue that this downside pressure waves that we've repeatedly seen into the 6 month now, if they don't take hold in this sell-off, this is it. This is their last chance. And the daily momentum says it better be like Monday and Tuesday. You don't want to uptick silver back into the low 70s again. If you do, I think you just saw it. The third attempt to break didn't take hold.
Markets keep printing fear headlines, yet repeated selling keeps failing to produce the collapse consensus expects. As Michael Oliver points out here, 6 months of pressure has repeatedly stalled near the same zone, and failed breakdowns often matter more than failed rallies. The overlooked signal isn't price weakness, it's absorption. If momentum resets while institutional buyers quietly defend levels, retail waiting for a dramatic crash may end up re-entering higher. Next, Michael Oliver reveals why repeated downside attempts may actually be the strongest bullish signal nobody wants to acknowledge.
And I argue that likely that once we turn up out of the third break, either we go to the 50s, and I'm wrong, or we hold here again and just below 70 and flip back up. You flip back up into the low to mid 70s again on silver. You look at a price chart, that doesn't mean much. But to our metrics, it says, hey, you're coming out of here, and you'll probably come out of here in a jolt. And
are we likely to see, if we do that and we bounce and it starts moving higher, are we likely to see that kind of parabolic move that we saw at the beginning of the year?
Yeah, I'm arguing technically, and this is based on a lot of factors, not just, it's certainly not fundamental, because we don't look at fundamentals. Yeah, we're aware of them. Silver's had a supply-demand deficit for half a decade. There's all kinds of other things out there. But we look at our momentum technicals, and we look at other markets and what they've done. And this move to a new reality in silver that we're arguing for, we argue $300 to $500 is highly likely once you come out of the congestion zone. All of our major long-term buy signals based on our stuff, like the last three were in 2024, we set a buy at March of 2024, $25 to $26 silver. We said you're going up, challenge the highs to $50 zone. We had a problem in 2025 around the $35 level. Took us 3 times to get up there. And we said the third attempt to rise up through 34, we said, this time you're going through. Boom. Suddenly went top of the range. Last November was our final buy. Silver was 56. That was based on silver breaking out versus gold.
Mm-hmm.
The biggest moves rarely begin when the story becomes obvious. They begin when people stop believing. According to Michael Oliver, momentum shifts matter more than headlines, and his framework suggests congestion is not weakness but stored energy. The real contradiction is that markets can stay structurally tight, even while supply deficits exist for years without immediate price response. For investors, the danger isn't missing the exact bottom. It's assuming old valuation rules still apply. Next, Michael Oliver exposes why breakout phases often look irrational only to people anchored to the previous cycle.
And silver's been a dog for quite a long number of years here relative to gold. And remember, it was 6.5% the price of gold back in 1980. Right now, it's under 2%. Okay. For the prior decade that we just went through, silver was capped against gold at a certain level. When we divided an ounce of silver into gold, you could see a chart. It was a beautiful ceiling. We broke through that in November. So the spread says, I'm coming out of here. That was almost simultaneous with silver breaking through the top of its price range. It had been $50. Did that in October. Sure enough, right after that spread breakout occurred, where did silver do? Gushed up to 120. Yes, it pulled back, but it pulled back to a level that's now 50% higher than the upper end of that range. On average, silver's been $75. Upper end of the range is 50. When you come out of this congestion zone, it's going to replicate what we argue copper did in 2005, lead did in 2007. They had a multi-decade range at stagnant levels, very low. Copper had a 50 cent to a $1.50 range for decades. 2005, it broke out and it quadrupled in price in a matter of several quarters without any help from another market and without any headlines. Lead did the same thing in 2007, quadrupled after coming out of a dead range for multiple decades. It suddenly went up, quadrupled in price, and it did so in a matter of several quarters, and then lived in a new reality. Why hasn't silver come out of its range until just now, when gold never stopped at a prior high?
When one asset lags for decades while its benchmark breaks records, that divergence deserves scrutiny instead of dismissal. What Michael Oliver is highlighting is not silver's past underperformance, but the timing of its relative breakout against gold. Markets rarely advertise regime changes in advance. They disguise them as noise and pullbacks. Investors focused only on nominal prices can miss that relative strength often shifts before narratives catch up. Next, Michael Oliver unravels why historical commodity breakouts tend to look impossible until they become consensus.
1980 high was 850. 2011 high was 1920. We got above 2000, in the past few years. Silver's still capped below 50. What's going on there? Copper wasn't capped, lead wasn't, gold wasn't. It reinforces the argument that someone tried to keep it under control. Well, they're losing. And we argue that the real explosion, and this occurred in copper and lead as well, where you had the first surge, but it was the last 3 months of the move where you went white knuckle flight vertical. And again, without headlines. I think. Who do you think
is trying? Any?
I don't. I'm not going to argue that point. We do know there've been a few convictions, in fact, but it's clear to me that something unusual was happening, because if the other monetary metal, the mama, gold, blasted through its highs every time, and by the way, gold, for example, people think it's overbought when you look at an arithmetic or a dollar chart, because it does. It looks, oh, wow, look at that. The bull market that ended in 80, it began from a 1976 low, was an 8-fold gain. It was the bear low to the bull high 8 times. Okay, 2001 to 2011, different span of time, 8-fold gain. We started from a low at 1,050 in 2015. We're only a 4-fold. We're half the dimension of the gold prior to bull markets that had far less explosive fundamental reason to go up than we do now. So even JP Morgan a few months ago put out a report, and I did not read it in detail, I just saw the headline, that ultimately $9,200 gold would not surprise them. Well, that sort of fits with the, hey, it did it again, another eightfold.
Public narratives call gold crowded, while long cycle comparisons imply the move may still be incomplete. Michael Oliver's argument suggests investors may be anchoring to price levels instead of measuring historical magnitude and cycle structure. The uncomfortable question is why institutional forecasts quietly tolerate numbers that public commentary treats as extreme. For wealth preservation, being early feels uncomfortable, but being structurally late usually feels expensive. Next, Michael Oliver reveals what institutional expectations imply about gold's ceiling, and why public messaging still sounds restrained.
Well, if gold goes to 8,000, you imagine where silver is, since silver is now outperforming gold? You do let's say silver goes back to its spread high in 1980, which is 6.5%, or even 3.1%, as it was in 2011. And gold's at 8,500. You do the math, okay? There's all kinds of factors that argue we're in a situation of a new reality move like copper did and lead did. And gold has done every time. Silver has been unduly restrained. And when a market gets overdone one way or the other, quite often when it corrects for the error, it goes berserk the other way.
So where should investors be looking for entry points? I mean, is this the time to accumulate before you have the move?
The optimal time has already come and gone. That's the problem. Long-term momentum gave its signals, and we quit giving long-term based triggers as of November. Again, it was $56. However, because the recent break did damage intermediate and short-term trend factors for gold and silver, therefore something that has to be rebuilt to get it going again. It's not the long-term. Long-term is totally intact. It's just a break within that context. What we're trying to identify at MSA in our continual reports is adjusting what numbers does it take on a shorter term to intermediate term to indicate that this congestion zone is about to be broken out above again, without waiting for the obvious price breakout above, 120 silver and 5,600 gold. There are numbers not far overhead that will do that. And if this plunge doesn't take hold, the one we're seeing right now on a short-term basis, and suddenly you find yourself back up in the low 70s in silver again.
If this consolidation lasts another quarter, the biggest damage may not be losses. It may be savers freezing, while repricing happens without them. This is where Michael Oliver's thesis shifts from prediction to positioning, because his framework separates long-term structure from short-term damage. Markets often punish people who wait for certainty more than people who endure volatility. For investors protecting purchasing power, the real risk isn't missing a perfect entry. It's assuming institutional accumulation announces itself first. Next, Michael Oliver exposes the one metric central banks are watching that proves they expect a devaluation cycle, not deflation.
We argue, put your helmet on, and if you're short, you better think twice. Because I think coming out of the hole this time, once we trigger our numbers, we're very number sensitive. We don't just hypothesize and wave our arms. We want to see the numbers triggered, and they're not triggered yet. But we trigger those numbers, and we think you'll come out of the hole very rapidly. That would be a place for a latecomer to say, okay, I should position somewhere.
Right. And what if anything would change your mind about this very bullish forecast? Is there anything that would have you?
I think the bull move is going to occur regardless. What would change my mind would be getting down to what everybody thinks is going to happen. Like we actually break down in a serious way out of this congestion zone, which again has been sideways, and go down into the 50s again. That would surprise me, and which I'd have to reassess. Does that break everything? No. Ultimately, the long-term trend's still up, but that would surprise me because I do think silver has signaled via various metrics, last year mainly, that it's going into a tantrum move. like copper did and lead did, and gold does every time. Eightfold moves, And silver, some reason, capped forever, No. And breaking out and having a brief surge to 120, and really the top weekly close was $100, by the way. Doesn't satisfy that. In fact, if you take the ratio scale charts of silver, gold, copper, and lead, not an arithmetic scale, but ratio, percentage scale, that copper move that occurred in late 2005 and peaked early in 2006 at $4.10. Remember, it came out of a range from 50 cents to $1.50.
Markets reward conviction only after exhausting everyone demanding proof first. Michael Oliver notes that a serious breakdown would force reassessment, but his bigger point is that invalidation levels matter more than headlines. Most retail investors spend more time reacting to narratives than defining what would actually change their thesis. If the structure remains intact while sentiment collapses, portfolios positioned only for safety may become unexpectedly exposed. Next, Michael Oliver points out the specific positioning tactic in COMEX, reporting that hides true institutional demand.
Most of that occurred in the last few months, but it was a doubling of the ratio scale of the prior base. Lead did the same thing. You had a range, and if you put it on a log scale and add it to the top, it did it. If silver had a ratio scale move, remember your range was $4 to 50, $4 to 50. That's a tenfold multiple gain from low to high for decades. If you take that dimension and add it to 50, it says 500. So there's all kinds of things that argue just to satisfy this pent up rage, in effect. Don't be surprised if it goes to levels of that zone, just to catch up to the degradation in the money unit, for example. So we still say 300 to 500. And once we break out of congestion, that likely will occur in literally 3 or so months. Very
wow,
rapid.
that's going to be a powerful move. Are you as bullish? So you see the best opportunity in silver, you're bullish gold. Are you bullish other commodities as well?
Yeah.
Or do you think most of the real action is centered in precious metals or monetary metals?
No, the commodity complex as a whole looks like an investment grade place to be. In fact, I would buy. Oil broke out for us, for example, in January. Our long-term momentum said buy oil. It was $65 West Texas. Okay. Now, the war started in March, really. And, everybody orgy came in buying headlines. You don't buy headlines. Okay. Very bad idea. So they probably paid $100, $105 for it. Went to 117 twice, West Texas futures. Now you're back to 90. Okay. So most guys who bought the headlines are probably losing right now. Okay.
Markets climbed on headlines while late commodity buyers quietly became liquidity for earlier positioning. According to Michael Oliver, the more important signal is not the price target, but the historical behavior after multi-decade compression releases. Institutions rarely chase narrative peaks. They build before public excitement arrives. For long-term investors, protecting wealth means distinguishing structural commodity trends from emotional, event-driven entries. Next, Michael Oliver walks through the exact timeline when institutional money shifted from bonds to commodities, and why retail is always 18 months behind.
And it wouldn't shock us you get back down to low 80s again, which would not negate our original buy signal at 65. It would just be, okay, let's flush the headline, guys. It's sort of like the guys who sold the stock market based on Iran. Iran's still here, but the stock market washed them out. They sucked them in and then kicked them out that way. Don't buy headlines. But anyway, right now, I think any pullback you see, like in the energy complex, especially if you get oil down in the low 80s, let's say, that will have flushed out the late chasers. But oil's still a bull trend. And I think you make 200, 300 barrel ultimately. But it's not an explosion process in the commodities. I think it's a multi-year uptrend, not what silver's about to do, but it's a multi-year uptrend in a broad asset category, which if you measure it against anything is so cheap relative to the real value of the dollar, relative to the S&P, relative to gold. It's an asset that's real. You step on it, you eat it. You know what I mean? It's real world, and it's off the page priced. We got bullish on Bloomberg. index, which is a broad index. In October, at 106.50. And right now in the sell-off, it's 132.50. And so, but from an investment grade point of view, non-leveraged, not options, think out 2-3 years. I think the commodity complex, you could almost throw a dart at the subsectors within it, and you'll make money.
The media sold geopolitical urgency, yet the market punished the people who acted on it fastest. What Michael Oliver is highlighting is that price often moves against the loudest explanation, especially during transitions into longer commodity cycles. Policy narratives focus investors on events while capital quietly rotates toward real assets over time. For anyone preserving wealth, the danger isn't volatility, it's trusting stories over positioning.